Mic check, mic check. What's going on, everyone? This is Jordan with Conquer Trading and Investing, getting ready here this morning for our live session. Live public stream, kicking off the new week here together. This last week of August, notoriously a very low volume. Not only is it a low volume week, this week happens to have a lot of sell pressure from CTAs. I think it's $103 billion in this type of environment. That could be rather, let's say, disorderly. This is normally a week that I take off, especially trading the foreign exchange market. This week and into next week is a week of vacation. Most traders are away from their desk, especially after Jackson Hole last Friday. A lot of traders waiting around. Be very careful out there this week, but we're just going to watch what's going on, talk about what happened on Friday, where we are today, and take a look across across markets. More importantly, and most importantly, is trying to get into a flow and pick up a groove as we move into September. As everyone comes back to their desk, as volume picks up, and we know how volatile historically September and October can be, we want to make sure that we are on the top of our game and have the clearest focus possible. We're going to start off just taking a look. It could be very challenging, right? I wait and I'm looking forward to the day when we have, once again, here on Bitcoin, green candles kicking off once again. That is not right now, and potentially could be a little while before it does. Not set up. I would be surprised if it were this week, but we'll keep watching and monitoring. Short positions on Bitcoin and Ethereum, both roughly now 15% into profit. A true surprise for myself, especially coming off such a beautiful gain on Ethereum, 52%. You don't usually put up back-to-back gains. I have to be honest, coming out of this, I would expect some volatility. When I say coming out of this, I mean the next series of trades. I'm already, as I always am, mentally prepared for, let's just say, 2/3 of them to be just stopped out in losses. I'm expected for, let's say, some chop, or I'm preparing myself for some chop. Not natural to be coming off the type of gains that we continue to put up back to back. And especially Ethereum, specifically Ethereum, continues to this is with no leverage whatsoever, just in 2022. Such a low drawdown, such beautiful gains. And Bitcoin now has the potential here on the short side, holding an open position of 15%, to all of a sudden start performing, I should say outperforming, for 2022. But that being said, I truly look forward to the time when the great green risings come back into flavor. Now, looking on this side, looking at Ethereum, I could say, well, that looks like, to me, that we're now setting up for what looks like a descending wedge. And that is a bullish pattern. Opposite of over here, we had that sharp rising wedge, which is already played out, whale plus target. I could see over here on Ethereum, now we have a descending wedge, bullish pattern shaping up over here. That's interesting. What about on the Bitcoin, right? Similar pattern, maybe, and just maybe it's true. Maybe we're reaching here, and that very well could be. Thankfully, I just know what side of the market to be on at all times, when to be in the market, when to be out, and on what side. Nevertheless, we're going to continue to make sure that we are able to adapt, whether it's CTM 1.0, TA style, that TA that has touched so many lives that we're going to be teaching here regularly, or whether or not it's putting into place a methodical, mechanical system that you don't have to, let's say, input any type of discretionary behavior whatsoever. Let's take a look across markets over here. If you at any point in time enjoy being here together, right? Again, just framing it. I like to frame each session each week. Today is more about showing up during this low, let's say, expected to be low volume week. Low volume weeks could mean exaggerated moves in either direction. It could be whipsaw-ish. It could get away from you in one direction. I remember going back, what year was this? I think it's somewhere around, I'm going to say 2015 on this particular week, out of nowhere, like during the Asian session, seeing the euro US dollar cross move like 250 pips for no reason whatsoever, low volume, late August, holiday week. Be very careful out there. If at any point in time, though, you do enjoy this time together, please go ahead and hit the like button. If you're watching this today on the replay, big shout out. I'm glad that you're here. It is good that you're here. John, happy Monday. What a blessing it is to be here with you all. We're looking at crude. Crude oil looks like it is getting ready here for a resumption out. When I say resumption out, what I'm looking at is this breakout of the trend line. Now, this breakout of the trend line is something that I myself as a trader said, you know what? Step back, stay back from, give it some room. And the room was over here actually right around 95.5. And price needing to clear above that in order to say that, you know what? It looks like we might have some oomph, a bit more of some more momentum here, and that would be taking us right towards 108, right? This sloping trend line over here, if I come to the weekly time frame, you could get a nice look at it, and you could see that when I go to these bar closes, ever since the invasion, right? The invasion of Ukraine, oil was not able on a weekly basis to close below this trend line. You could see that happening over here, wicking down intra-week a few different times, but not able to close below up until this week over here, first week of July, closed below it, and since then has been in a nice downtrend. When I say nice downtrend started much higher, all the way over here at 119. This is on the public channel over here. The macro could change rapidly. We were watching the sell impulse occur over here in crude oil to see whether or not we would see the greatest causes of the recent inflationary pressures month over month start receding. Sure enough, that has happened. Now, one thing that we're watching for now is when they start rising again. That could be concerning. This trend line over here that I pointed out to you, this one coming off of, I don't have my pointer put in. I need to get that in. This trend line over here, we were just looking at on the weekly, a close above that, and that's going to signal to me that there is a strong indication that oil could go ahead and actually be retesting, remaking new yearly highs. If that's happening, I think that the markets are going to be under severe pressure. It'll mean to me, or it's signaling to me, that these inflationary pressures are just really getting out of control. Why right now it appears on a near-term basis they could be subsiding. A big worry is that in the future they're going to pick up again. I do believe they're going to pick up again. What we're trying to do is time when that might be happening. And to do that, what we're going to be doing is watching. Just trying to get off over here. Boom. All right. And to do that, we're going to be watching specifically oil, but and from afar, food-related commodities. And then I just need to get out of Ghost. There we go. Now we're back in it. So what I'm watching over here now is I wanted to give a little bit of room on this breakout. You know, very often trendline breaks are taking in a traditional market like oil. They're not taking on the breakout. It's a breakout, a retest, and a resumption. Here you have over here that actually taking place. You have the breakout came in for that retest. The retest was horizontal support. Okay, horizontal local support, where right over there, that was that resistance, and that's where it's coming in. If now the resumption's got to get above this area over here, it was marked in yellow anyway, right? Above there, that's going to signal, all right, watch out. Oil might be putting in a move. This was sparked, by the way, this big candle over here was sparked by some potential fundamental news. It was the Saudi Arabia saying, we're not really happy with the paper price of crude. We don't think that it's reflective of the physical side of the market. And you know what? If you continue working towards any type of agreement with Iran, who we deem to be an enemy, we're going to go ahead and OPEC is going to cut production. And since then, oil so far has responded in kind. bid a little bit. Now, the one thing is that, well, that's not really indicative of the central banksters looking to go ahead and, cause this global recession. Title of this video is Central Bankers Looking to Cause a Global Recession. Well, we haven't had the resumption yet. If we get the resumption, I think that there's a lot of play involved. I think this thing could go a lot further. And then the next area we're watching and targeting would be over there around 108. That's enough said on that. But I think that was kind of opening up to what happened this past week in Friday in Jackson Hole. My own opinion was that Powell was going to walk a fine line between being hawkish and dovish, and that did not happen. I think that Powell came out, let's say, appropriately hawkish. Now, it might seem on Friday that how he came out was overly hawkish. That part I don't agree with. He came out, there's no discrepancy. He came out hawkish. There was zero walking a fine line between dovish and hawkish. There was no dovish involved. He came out hawkish. However, he did, like every other part of the analysis that I shared on Friday, is 100% in play as far as we're going to be looking at next Friday jobs numbers, and then CPI is the most important. I do believe that CPI is, depending on how it comes in, is going to affect whether or not we're looking at a 50 basis points or 75 basis points rate hike at the end of the September. Now, after Friday, after Powell's speech, the odds of a 75 basis point rate hike increased. It increased to about 60%, right? That's not that much. That's basically taking back or putting it back where it was just a few weeks earlier. So I think like the easiest way to look at what happened was that the market on Friday repriced those dovish expectations coming off the last FOMC meeting. I personally think the market is literally data dependent. And what happens, as we said on Friday, Friday early in the morning, our analysis on coming into September, what is going to affect what the Fed does. I know that Powell mentioned that a 75 basis point rate hike in September is possible. But that's what we mentioned prior as well. That was dependent on whether or not, in my view, whether or not CPI in September comes in higher than 8.5%. So why the pre-analysis view was wrong. Powell did not walk a fine line between dovishness and hawkishness. Everything else, nothing else has changed. See, I'm a trader. I'm an investor, which means that as the market is constantly pricing in new information, so am I. So I really let's say, value the ability to be able to change my mind and my opinion. I'm looking to do that all the time. I don't think that anything that I believe today, 3 months from now, should be the same. I mean, not that it couldn't, but I don't think that it's going to or should be. I do believe that as an investor, you're constantly looking to take in all information that the market is absorbing and then reforming your overall view. If you could stay fluid like that, I like to say be fluid like water. Bruce Lee, be fluid like what? If you could be fluid like that, if you could go ahead and spend, let's just say, an enormous amount of time forming a view, forming a thesis, and then in an instant, in a heartbeat, be able to drop that, to turn on a dime because something new to you was introduced, there you go. Then you have a good foundation to be working off of. I could say, for example, for myself, the bullish case for Bitcoin is something that is very, very strong. I do believe for many, many different reasons in Bitcoin. The reason why I'm a Bitcoiner has a lot to do with the hope for a future, for my children's future, for humanity, for freedom, right? I wanted to talk about and get the opportunity to present to you today. There's a couple of infographics that I'm waiting on that I wanted to pull up, but a lot about central bank digital currencies. And I just want to plant that. There you go. I want to plant that seed in your mind and bring it to the forefront, because if we're talking about central bankers going ahead and coordinated a recession, it could very well be because inflation right now is out of control. They had to have known that, though. They had to have known that their policies there were going to create inflation and sticky inflation. And when I say that they had to know that, is because we all did in real time as it happened. Now I know there was some macro experts out there. The guy with the paper hat, right? Stephen Matt. He said that this was going to be deflationary. And then I know the Euro Dollar University Jeff guy. He also was like, no, QE's deflationary. All right. I think now that, and then you had like Kathy Wood, Kathy said it's No. Of course. We all knew it was going to be inflationary. There's no question about that. Right. Outside of, the few that and then you have the great Dr. Lacey Hunt. But Lacey Hunt said it's going to be deflationary. Yeah, that's great. Okay. You got to be able to adapt. Things are changing. There you go. So, I had to believe that these central bankers understood the effects of their policy. Now, I also think that they're very well planned. Everyone always talks about the Fed gets it wrong. Oh, if the Fed gets it wrong, then how come all of a sudden everyone is like, don't fight the Fed. This is what the Fed's doing. And it's just like this time that their projections are going to be correct. Well, I don't know. Because I got a bit of experience in the market. It's not usually how it works. Anyway, what I'm worried about is if they are orchestrating this type of inflation and now looking to look at the energy prices, you look at the self-sabotage, it doesn't seem natural. It doesn't seem as if the leaders have, let's say, a good plan in place. It's concerning what might be happening in the future. You have to wonder, what is the purpose of it? Do you cause inflation only to turn around and then cause a global recession so that you could go ahead and fix that problem you created? Or is there something else at play, right? You have over here Minnesota Fed president talking about the advantages of a central bank digital currency. And he goes on to say, well, there are no advantages. We have Venmo already. If you want to send money to someone in an instant, if you want to impose negative interest rates and directly tax customer accounts, well, that's an advantage. You can do that with the CBDC. But why would the American people, why would they be up for that? There's no way that they would be up for that. And unless that things got so bad that unless people were not able to feed their families, that people were not able to heat their homes, and the only way they were told that they could get out of this situation was that if these CBDCs were implemented, then you would have people begging for something that no one in their right mind would normally accept. That's my fear. And that fear is nothing new. If you come back to this channel on the public side, back in April in 2022, I was then having those conversations. And I was saying the Fed just expanded their balance sheet by $4.1 trillion. I know that your macro bro is telling you that there's going to be some type of insolvency event, but they're good. The system now is flooded. There's probably not going to be any other type of crisis until they're ready to introduce the CBDCs. The question right now is, are they ready, or did inflation actually get out of control unbeknownst to their expectations? And are they trying to do the one thing that, even though they know that they can't through policy bring in inflation, so they're trying to then just go ahead and demand destruction? Demand is the only part of the equation that they could really facilitate. Are they trying to destroy that? And that is, let's say, are they doing that for the good of the people? That's the part that's hard for me. I don't really think that they are looking out for the good of the people, the central planners. I think that they are looking out for they have different motives. So that there is the Monday conversation I wanted to have with you all. And that's something that's real. I don't know. And it's how we navigate the future here is very, very, very important. It's very important on so many different levels. And largely, it has to do with whether we believe them or trust them, right? What's going on here? What are the motives and why? This over here was a phenomenal read. This is behind a paywall on Zero Hedge. This was the best read that since I could remember. And I will find a way to go ahead and present it to you. It was the title is What Will the New World Order Look Like After Europe's Minsky Moment, where $2 trillion of German value depends on $20 billion of Russian gas. But this is fascinating, talking about when we spoke about Zoltan's view of Bretton Woods 3 back in March as it was developing with the invasion of Ukraine and the EU and the United States' response, what this new world order is beginning to look like with, let's say, the BRICS forming a closer alliance. And this is just like absolute candy. So today, obviously, I'm not going to, it was a long read too. Can you imagine? I went through this with 2 pauses. I went through this like almost nonstop. When you find something like that, it's beautiful. I will find a way to present that with you. And, or I saw over here that they're having tomorrow. I signed up for it. They're having, let's say, a breakdown. They will be hosting a live episode taping featuring Zoltan and Perry Maryland. I'm not familiar, who will join us to debate the future of the dollar. Something I'm very interested in. Let me go ahead and throw it in the chat in case you are. You might want to go ahead and also sign up. There's an email over here. Let's say how to respond to an email. I don't see it. You could go through there and find yourself. If I get any information as I get the opportunity to check through my emails later today, I'll make sure tomorrow morning I get that in front of you as well. We have over here, Powell's speech in Jackson Hole was clear, yet bond markets in blue, right, believe the Fed, orange, will aggressively tighten until December, but they are very skeptical the Fed can keep hiking 2023 and later. So, look, let's just be true and honest. There's never a time that you can point to 2 things, that the Fed's projections have been what happened, and also that the general analysis out there has also been correct. Those 2 things, like if you go back and you look at before QT started, 2018 era, and you look at the investment banks and they talked about what their expectations were, what the timeline was, how it was not even close. So again, that comes back to one of the lessons from today. Have an opinion, form an opinion, but be continuing to feed and form that opinion, because the market doesn't stay static. And if you stay static, you're going to get destroyed. All right. Not much else to add or say over there, except over here. I tweeted this out as something that I thought the first time I ever got to interact with Darius, because what he was saying over here happens to align very closely with the way that I see it, the way that we talked about last week, the amount of liquidity out there. And Darius, by the way, going back to December, has been quite bearish on the overall markets. He's saying Powell told investors to start preparing for 2023, where the Fed's fund rate stays parked at 3.5% to 4% the entire time, along with $1.1 trillion of balance sheet reduction via quantitative tightening program. That's pretty hawkish. You also need to prepare for a world where 3.5% to 4% is barely restrictive, if at all, for the economy. I've talked about when I said that I believe that the Fed believes the economy could withstand the tightening, that they genuinely believe that. Again, we've talked about by now, a lot of people thought that everything would have broke, and everyone continues to say the Fed is going to tighten until things break. That doesn't necessarily mean when things break, it's going to be something disorderly. I know a lot of people think about like Lehman 2008 and what that was like for the financial markets. If you remember in 2019, September 2019, under quantitative tightening, the market broke, the repo market broke, and balance sheet expansion had to begin. Risk didn't trade off. Let's go ahead and just look at that moment really quick together. We'll do it through the view of the S&P 500. And I'm just coming back over here to September 2019. And this is when the market breaks. Huh. Wait a second. So you're telling me this is quantitative tightening over here. This is rates rising and the markets through this massive tantrum. That was disorderly, right? And then when that happened, what was interesting was that Fed all of a sudden hike rates and the market begins rallying. A couple of weeks later, the Fed says, you know what? We're going to move back towards an accommodative posture. So the market bottomed on the rate hike. Quantitative tightening keeps running, and it runs all the way till September 2019 when the market breaks, balance sheet expansion begins. And the market, when things broke, didn't have the type of disorderly behavior that most people believe. A lot of people think this is what a disorderly market looks like when things break, and things did break here. This was kind of easy. Y'all remember we did this in real time. We were able to start shorting like mid to late February, taking risk off positions through the Japanese yen, through the Swiss franc against commodity currencies in the foreign exchange markets, along with shorting the S&P 500. And not only that, we were like, you have to hold these trades. You have to push these trades. These are not swing trades. You want to make sure you capitalize. It was, and then things got really bad and disorderly. That's what a lot of people are looking for and hoping happen again. Why are they hoping for that? Because they feel that, like, you know what? Hey, if things crash and then I'm able to lean in, at that point, I don't have to do anything else. I could just, it's never that easy. And by the way, if you remember this whole way up from March, the end of March over here through the summer, people calling for insolvency events, market crashes, and things like that. It's never easy. And I think that the more that you realize that, you're setting yourself up for much more success. Let's take a look across markets over here this morning. I want to start off with the 10-year is saying, all right, you know what? We were not really priced appropriately. And I think that the Fed is going to continue tightening. Now, if you remember, my own personal base case is that September has a 50 basis point rate hike, unless the CPI in September is higher than 8.5%. Then I think it's a 75 basis point hike. I think that November is going to be a 25 basis point hike. And I think that potentially we'll be looking at another 25 in December. None of that has changed. That could change. If that changes in real time, I'm going to try to be able, the next thing that we have that could potentially change that for myself will be, again, this coming CPI, and we will watch how the market reacts to that. We will watch that day how the Fed, what the futures market is pricing in as far as rate hike expectations in September's FOMC meeting. And over here, the 10-year has really only done this after going on the and probably one of the best reads that we've had over these couple of years has been on the 10-year. But once we started this massive move up, all that we've seen since is nothing more than a reversion to the mean, right? Like that move up might have been a little a little bit much. And then you saw, price come back down, and now it's just reverting to the mean. And really that's where we're at. We're at the mean. And I also have to say that was along the lines of our expectations. We just kind of wanted to get out of the way here and give it a little breathing room, feeling that it was going to get a little bit difficult to trade. True to expectations, that's what's happened. And we're just going to let that thing breathe, I think, through the end of September or mid-September. Then we'll get a better idea. I am liking oil's price action today. It's looking that even though the world is getting ready here for this tighter, more restrictive policy, we're finally seeing the oil market say, all right, well, regardless of the slowdown of demand, we think that we need to go ahead here and get ready to put in a move. So watch it. I wouldn't be biting here this week on a Monday. Personally, it doesn't mean this move won't get away from you. I would feel much more comfortable with price resuming here and then coming back for some type of retest and then another resumption. Otherwise, just watch it and just stand on the sidelines. There's nothing wrong with watching something get away from you. You don't want to chase things that just, again, bringing it back to the best trade you're going to have is not so much a lot of people looking to take as many trades as they can take. First of all, that's a big red flag, but just waiting for something to look almost too good to be true, that's a good one. Waiting for something to be clear rather than forcing something. What else? Gold this morning, I think, is interesting, only that you are seeing actually gold and oil doing two different things. It appears that oil is saying, well, I'm not buying the whole global recession thing. Or it could really just be, well, I just really don't think that, again, I think the Saudis are serious. OPEC is going to not be happy when they understand what the real demand is for oil, and seeing the price not reflective of that. Yeah, they might actually step aside. And just as the strategic reserve of the United States gets depleted, they might actually start. So you have like this extra like supply being flooding in the market. Just as that finishes, they might actually cut back on production. That would be a double whammy. And a triple whammy will be, by the way, when they need to start refilling the strategic reserves right after the midterm elections. That's a national security threat. Not having that, that's exactly why that oil's there, in case you need it, right? So they're going to have to refill that. That might actually cause demand destruction. That might actually push us over a cliff if you're seeing the Fed continue to tighten, people losing their jobs, the economy continue to weaken, and then all of a sudden OPEC cuts down production of oil, and then you see that with that lower production, that higher demand as they begin filling the strategic reserves, that might push up oil and get it skyrocketing, and then you might have real demand destruction, as that's just going to be the final blow that really knocks out the economy. Watch out for it. And then you see over here, gold saying, all right, I buy it. I think that actually we're going to be what I thought was happening over here from the end of June into July, right? And then so there you go. Boom. Over here, no, I take that all back. Doesn't even fit what I meant to say or talk about. So I guess what you could say, and you could hear my tone and my slowdown, so I don't buy it. What I was going to say to you, and I don't buy it, is that what we were looking at over here, because it's a little late. So this is when we had the 8.5% CPI reading, and then finally we saw gold getting knocked back down. I mean, we lined that up over here. The red dot was the technical breakdown. The green dot was an opportunity at the long side. This was, you're wrong on the trade. After that, it was a big breakdown, a resumption in, right? And then we're looking for a resumption back down. This is coming off of what? Well, CPI is coming off, and it might be that actually the rate of hikes are actually coming off. People like to refer to it as a soft pause, but what it means is that maybe growth is returning, and if growth is returning, there's no reason for gold to be in favor. Gold starts trading off, and then all of a sudden Powell's like, no. We're going to keep going. We're going longer. We're going higher. Again, that didn't really change any of our expectations yet through the end of the year. And that's September's dependent on what happens through the data the rest of this month. But then here today, you might see that actually gold is going bid, rightfully so, as growth continues to slow down or is expected to slow down. That's where gold gets the opportunity to shine. So that's what I wanted to say, but I don't know that I buy it all. So look, sometimes we're not that clear. Why are you looking at 2019 data? Things are much more different. What? I don't know. I'm Anton. I'm a little behind on when you asked that comment and what we're looking at now. So could you let me know a little bit before? Yeah, that's true. Well, I want to add on that. I do believe that at this particular time, as we've seen since over here in March when we had the beginning of this rate hiking cycle. So let me come over to March, right? May, March, all the way up here, right? And coming into the rate hikes, I think that gold was acting appropriately. Gold at the beginning of a rate hiking cycle generally begins to fall in favor as you're looking at growth slowing down. And that continues. That cycle lasts as long as the Fed's rate hiking cycle. And then as they begin to actually not only pause, but then cut rates down until things ultimately crash. And then that QE starts again. And then after that QE start, like gold then is shooting the moon. And then right before all that QE takes effect and then growth starts returning as the economy is stimulated, that's when it's time to exit gold. But that's not what's happening. So ever since the rate hikes began, gold is coming off. Now, in hindsight, when I say hindsight, fast forward until things break and QE starts again, whether that is in whenever that is, 2024, 2025, there's no way that I could even look beyond 60 days right now. I can't tell you when that might be or anything like that. Who knows? But, back then gold might be trading a lot higher, and this might be nothing more than a little bit of a bump on the road. But so with the dollar sign, I feel also, well, it seems like the masters here are doing whatever they can to artificially take down the price of gold here, and that might continue until it's repriced. We see and we talked about that new changing dynamics of the world order, and throughout that new changing dynamics of that world order, the other side, when I say the other side, I'm just talking about the BRICS, or I'm talking about China and Russia, and I'm talking about the Saudis building gold refineries now in the kingdom. And I'm talking about Nigeria building gold refineries, 7th largest oil producer in the world. Saudis, top oil producer. And why are they doing that? And then you look at the market, the gold market going from London to Shanghai, and it seems to me there's going to come a place in time when gold is drastically repriced. Is it possible that gold may just completely be out of favor until then? Could be. It could be. OG, what's going on? Thanks for being here, E. Thanks for smashing that like button. I do appreciate that very, very much. CBDCs will happen. I mean, it's one of those things with when you begin following things. By the way, for me, it was in 2019 reading an IMF white paper on CBDCs talking about how they were going to back it by the SDRs. And I mean, these people lay out their plans. They seem to be following. The dollar will completely fall, and I'm not okay with that. U.S. citizen, take the dollar, not the mark of the beast. Yeah, none of us are okay with it, but we've seen what happens before, and, they're very good at programming, and a lot of people will embrace, let's say, however they're programmed. I felt like this new, let's say, like the inspiration to make sure that we are more vigilant and diligent than ever, including looking at what all risks can be in the future. We may look at Bitcoin as hope, and they may look at it as a threat. And we all know, we've often talked about when the fight begins, it could get ugly. Anyway, that's a time for a different time, a different place. And I think one of the things that needs to be talked about here today is also probably the most important. I think I have some notes up here, and that is, I don't know if you could read them. That might be a little out of skew, but just in case that from afar you're not aware of it, one of the biggest, let's say, releases of Friday was not really Jerome Powell, who basically, again, did not walk a fine line between dovish and hawkish. He just came out plain hawkishness, although that he didn't change any of whatever expectations we already had out there. but he didn't give those that might have like any type of dovish hopes, any type of like, breadcrumbs to be able to hold on to whatsoever. At the same time, nothing new was introduced whatsoever. But what was introduced, and we're looking at when, I need to pull up the calendar over here. When's the ECB meeting? And we're looking at the ECB getting ready for a hike, whether or not it's going to be 50 basis points. There we go. On Thursday, September 8th, or even potentially 75 basis points. That's something that the market was not ready for, prepared for. And that is something that added to Friday's sell-off in the U.S. equity market. Now, the dollar this morning, I think it's important to look at and see what's going on. Let's take a look together. And let's see how the dollar is doing. It's unchanged on the day, right? That's something, because we talk about, well, DXY, US dollar index, people think that, well, that's indicative of the US dollar. Well, kind of, but weighted 57% towards the euro US dollar. I know we just did this together, and if you went ahead and just pulled up a chart of the euro US dollar and edited it, let me go ahead and do that. Where's ICE? And, oh, all right. So really the DXY is an inverted chart of the euro US dollar. Well, it's kind of hard to argue that it isn't. Yeah, it is, and because the weighting is so high. And the next biggest weighting is the US dollar, Japanese yen, or is the Japanese yen, I should say. And right now we've seen as the Fed is tightening and, the Japanese continue to ease, printing massive amounts of yen to defend their yield curve. That's what we're seeing in the dollar market. And if we see the euro change their, let's say, central banking policy and move towards tightening, that could affect the dollar, right? And for the reasons we just discussed. So that's something that is new. That's something that needs to be reevaluated. That is something that needs to be absorbed by us as we continue here to put all the pieces of this massive chessboard together. So I think that's our segue into this week. And we're going to keep this short and sweet today. Holiday week over here. Just kind of wanted to paint the picture. Stepping away after such a volatile Friday, giving not only today into tomorrow a chance for things to settle down, and then why it's potentially possible during this holiday week something clear develops. It's hard to argue that what's developing on oil this morning is not real and legit, but again, I just feel out of prudence where a resumption might be in play. Give it a little room here. Let's see what happens. Let's not get tugged in over here. There's no reason. The market's always going to be there. There's always opportunity. And I think one of the lessons that I wish I would have learned very early in my career, because very early on, I thought a few different things. I thought, first of all, the more I trade, the more money I can make. Not true. I thought that the lower the time frame, the better, because I have the more opportunity to make more. And I'm looking for something that's super volatile, because the more volatile it is, the more money I can make. Again, not true. And I think that if I would have known and understood that on a week like this week over here, last week of August, that if I stood aside and didn't trade, it was better off in the long run. I know as someone new, as someone inexperienced, that was hard for me to understand. I didn't understand it. It took me a long time to understand the value of that, to have those lessons taught to myself through the hard way. Sometimes you have to learn through experience. Sometimes, if you're stubborn, like myself, you need to learn through experience. So people told me over and over again, contrary thoughts, and you know what? That's for them. I'm myself. I'm gonna do it anyway. Yeah. So sometimes experience is priceless and valuable if you learn from it, at least. So everyone, there you go, Craig. So really big smile on my part to be here to continuing this new journey with you all. And again, why I wouldn't even be here otherwise. I'm making sure that I'm committed to all of you. So If you are as well and you haven't yet, please go ahead and hit that like button. If you're watching this on the replay, share anything, any thought that you have about today's session. Anything of value would be greatly appreciated. I read all the comments. And if you're new here, welcome. Make sure you subscribe to the channel. I'll see you all again tomorrow. And we're going to go ahead and build up and gain some momentum coming into prime time being September, right? And we're going to make sure that we're coming in as strong as possible. Thanks for being here, everyone. I hope you have a beautiful day. May God bless you, and I'll see you all again tomorrow.